There is a single word that terrifies the world's greatest investor more than any other. It's not recession. It's not inflation. It's not competition. It's a three-letter word that Wall Street has rebranded as a sophisticated tool, a shortcut to growth, a mark of aggressive and clever management. That word is debt. To Warren Buffett, debt is not a tool. It is a disease. It is a financial cancer that, once it metastasizes within a company, can destroy even the most robust and promising of enterprises. While business schools teach students about the wonders of leverage and optimal capital structure, Buffett has spent a 70-year career demonstrating a far more profound truth. The single greatest competitive advantage a company can have is to not need anyone else's money. A business that cannot fund its own operations, that cannot finance its own growth from the cash it generates, is, in his mind, an inherently inferior business. It has a fundamental flaw in its DNA. This isn't a preference, it is a non-negotiable, first-principle filter. Before he even looks at the income statement, before he analyzes the business model or the management team, he first glances at the balance sheet. If it's riddled with debt, the inquiry is over. He moves on. This simple, almost archaic rule is one of the most powerful secrets to his success, because it is the ultimate tool for risk management. A company with little or no debt cannot go bankrupt. It is sovereign. It is the master of its own fate, beholden to no one but its customers and its owners. In a world obsessed with maximizing short-term returns, Buffett plays a different game entirely, the game of permanence. He is focused, above all else, on avoiding permanent capital loss. And the fastest way to permanently lose capital is to invest in a company that has handed a loaded gun to its creditors. Today, we are going to deconstruct this core tenet of his philosophy. We will explore why this extreme aversion to debt is not financial conservatism, but the highest form of financial intelligence. We will build from the ground up the 5 pillars that support his belief that a pristine balance sheet is the ultimate hallmark of a truly wonderful business, and how you can use this simple, powerful lens to transform your own approach to stock market investing, business, and personal finance. This is more than a lesson in corporate finance. It's a lesson in resilience, independence, and the art of long-term investing in a world addicted to short-term fixes. The first and most fundamental reason for Warren Buffett's lifelong aversion to debt can be summarized in a single, powerful concept: the fortress balance sheet. This isn't just about being financially prudent. It's a philosophy of corporate survival rooted in the understanding that debt is the primary agent of fragility in a capitalist system. A company, no matter how great its products or brilliant its management, introduces a fatal vulnerability the moment it takes on significant leverage. It creates a single point of failure that can be triggered by events far outside its control: a recession, a panic in the credit markets, a sudden shift in interest rates. A fortress balance sheet, one with minimal or no debt, is the only defense against the inevitable storms of the economic world. It ensures that a company's destiny remains in its own hands, a principle Buffett learned not in a classroom, but in the grim, grinding reality of a dying industry. To truly understand the origin of this mindset, we must travel back to the 1960s, to a struggling textile town in New England, and to a business that would become both Buffett's biggest mistake and his most formative teacher, Berkshire Hathaway itself. When Buffett began buying shares in Berkshire Hathaway in 1962, it was a failing textile manufacturer in New Bedford, Massachusetts. The American textile industry was in a state of terminal decline, fighting a losing battle against low-cost foreign competition. The mills were old, the machinery was outdated, and the business was what Buffett would later call a, quote, financial tapeworm, consuming ever-increasing amounts of capital just to stay in the game. He bought it cheap, a classic cigar butt investment, thinking there were a few free puffs left in it. But what he inherited was a lesson in operational misery. The business was a cash-guzzling machine. Every year, to keep up with competitors, Berkshire had to invest millions in new looms and equipment. Yet, these investments produced no meaningful increase in profit. They were just the cost of treading water in a sinking ship. The brutal economics of the textile industry were clear. It was a commodity business with high capital requirements and vicious price competition. Now imagine adding debt to this already toxic mix. Many of Berkshire's competitors did just that. They borrowed money to finance new equipment or to survive a lean year. But in a business with paper-thin margins, that debt became a hangman's noose. When a small downturn in the textile cycle occurred, or when a new wave of cheaper imports hit the market, these leveraged companies faced a crisis. Their revenues would fall, but their interest payments to the bank remained fixed. Suddenly, the cash they were generating wasn't enough to service their debt. They were forced to make desperate decisions, cutting prices even further to generate cash, laying off skilled workers they couldn't afford to lose, or skipping vital maintenance on their machinery. The creditors were in control. The bank didn't care about long-term strategy, it cared about its next interest payment. Buffett watched this happen, and it burned a lesson into his brain. Berkshire Hathaway, the textile operation, was a terrible business, but it survived for as long as it did for one simple reason. Buffett refused to saddle it with debt. He ran it on a shoestring, using only the cash the business itself generated. While its competitors were answering to bankers, Buffett was answering only to the grim reality of the marketplace. This gave him a crucial, if painful, degree of flexibility. He had the freedom to make the rational, albeit difficult decision, to gradually liquidate the textile assets and reinvest the cash into far better businesses like insurance and See's Candies. Had Berkshire been leveraged, this option would have vanished. The bankers would have likely forced a fire sale of assets or a bankruptcy proceeding long before Buffett could execute his strategic pivot. The experience of managing a capital-intensive, low-return business taught him that in such an environment, debt is an express train to Chapter 11. It transforms a difficult situation into an impossible one. The fortress balance sheet is not an abstract theory. It is the practical application of this painful memory. It's the understanding that the future is unknowable, and that the only way to guarantee survival is to eliminate dependencies on the kindness of strangers, especially when those strangers are bankers. The psychological principle underpinning this entire philosophy is one of the most powerful forces in human behavior: loss aversion. Pioneered by psychologists Daniel Kahneman and Amos Tversky, loss aversion describes our tendency to feel the pain of a loss approximately twice as powerfully as we feel the pleasure of an equivalent gain. Losing $100 feels far worse than gaining $100 feels good. This simple asymmetry explains a vast range of irrational human behavior, but for Warren Buffett it is the very cornerstone of a rational investment framework. His entire approach to corporate finance and stock market investing is engineered to minimize the possibility of ever experiencing the acute, irreversible pain of a catastrophic loss. Most of the financial world, driven by bonuses and quarterly performance reports, is focused on the right side of the curve, maximizing gains. They see leverage as a powerful tool to amplify those gains. If you can borrow money at 5% to invest in an asset you believe will return 15%, the math seems irresistible. This is the siren song of Wall Street. It's a game of offense, of trying to score as many points as possible. Buffett, however, plays a different game. His primary focus is on defense. As he famously says, rule number 1, never lose money. Rule number 2, never forget rule number 1. This isn't just a catchy phrase, it's a precise articulation of a strategy built around extreme loss aversion. Debt, in this context, is the ultimate violation of rule number 1. Why? Because leverage is a double-edged sword that is far sharper on the downside. While it can amplify gains, it can also amplify losses to the point of total annihilation. A 10% decline in the value of an asset for an unleveraged investor is just that. A 10% decline. Annoying, but recoverable. For an investor leveraged 10 to 1, a 10% decline is a 100% loss. It's game over. You are wiped out. The pain of that loss is not just twice as bad as the equivalent gain. It is infinitely worse, because it removes you from the game entirely. You can't come back from zero. Buffett understands this on a visceral level. His aversion to debt is a systemic way of building loss aversion into his entire decision-making process. He is willing to accept slightly lower returns in the good times in exchange for the absolute certainty of surviving the bad times. The 99% of investors, driven by greed and a desire for quick riches, do the opposite. They are seduced by the upside potential of leverage, systematically underestimating the probability and the emotional impact of the downside. Their thinking is linear, but the world of finance is nonlinear. They fail to appreciate that the risk of ruin is not just another variable. It is the only variable that truly matters for long-term investing. By making a pristine balance sheet a prerequisite for investment, Buffett is hardwiring his portfolio against the single greatest cause of permanent capital loss. He is exploiting a psychological flaw in his competitors, their inability to properly weigh the devastating pain of a total loss against the fleeting pleasure of a leveraged gain. This is not about being timid, it's about being a realist. It's the recognition that in the long game of wealth preservation, the person who avoids the single knockout punch will always beat the person who lands a few extra jabs. So how do we translate this powerful principle into a practical, repeatable process? The applied mental model here is a technique championed by Buffett's partner Charlie Munger, the principle of inversion. Instead of asking how to achieve success, you ask what is most likely to cause failure, and then you structure your life or your business to avoid it at all costs. As Munger says, all I want to know is where I'm going to die, so I'll never go there. When applied to business and investing, this model becomes a powerful tool for risk management. The conventional approach asks, how can this business grow and generate maximum returns? The inverted approach asks, what is the single fastest way this business could be destroyed? In a surprisingly high number of cases, across almost every industry, the answer involves debt. The inversion blueprint for analyzing a company's financial health is a four-step process. Step 1. Identify the inherent vulnerabilities of the business and its industry. Is it a cyclical business, like construction or automotive, that experiences wild swings in demand? Is it a business, like a technology company, that is susceptible to rapid technological disruption? Is it a business, like a retailer, that faces intense and constant price competition? Make a list of the specific, plausible nightmare scenarios for this company. Step 2. For each scenario on your list, analyze how the presence of significant debt would act as an accelerant. For the cyclical company, debt turns a normal downturn into a liquidity crisis. For the tech company, debt removes the financial flexibility to invest heavily in research and development to fend off a new competitor. For the retailer, debt makes it impossible to survive a prolonged price war started by a debt-free rival. You will quickly see that leverage transforms manageable business problems into existential threats. Step 3. Establish a non-negotiable quantitative filter based on this analysis. This is your personal margin of safety for a company's capital structure. For example, you might decide you will not invest in any non-financial company with a debt-to-equity ratio greater than 0.5. Or you might require that a company be able to pay off its entire debt load with less than 3 years of its average pre-tax earnings. The specific numbers are less important than the discipline of having them. This filter is your automatic defense system, protecting you from the temptation to fall in love with a good story about a fragile business. Step 4. Conduct a pre-mortem. Imagine it is 1 year in the future, and the company you are analyzing has gone bankrupt. Write a detailed story of how it happened. What was the trigger? Was it a recession? A product failure? A new competitor? Then, trace the chain of events backward. In your story, how did the company's debt load contribute to the disaster? Did debt covenants restrict its options? Did interest payments consume all its cash flow at the worst possible moment? Did it have to sell its best assets to appease creditors? Now run the same pre-mortem scenario but assume the company had zero debt. Would it have survived? In most cases, the answer is a resounding yes. This exercise makes the abstract danger of debt concrete and terrifying. By consistently applying this inversion blueprint, you shift your focus from forecasting the future to building a portfolio that is resilient to an unpredictable future. You stop trying to be brilliant and instead focus on not being stupid. And the most common form of stupidity in corporate finance is believing that you can dance with the devil of debt and not eventually get burned. To fully appreciate the wisdom of the fortress balance sheet, we must examine its opposite, the path of the 99%. This is the path of growth at any cost. A mindset fueled by ambition, greed, and a fundamental misunderstanding of risk. The most potent illustration of this philosophy is the modern leveraged buyout, or LBO, a favorite tool of the private equity world. The mechanics of an LBO are simple and seductive. A private equity firm identifies a target company, often a stable, cash-generating business. They then put up a small amount of their own money, say 20% of the purchase price, and borrow the remaining 80% from banks, using the assets and cash flows of the target company itself as collateral. They buy the company, take it private, and now the company that used to be debt-free is suddenly saddled with a crushing debt load. The goal is to use this leverage to magnify their returns. They'll spend a few years aggressively cutting costs, selling off assets, and using all the company's cash flow to pay down the debt. If all goes well, they can then sell the company or take it public again, paying off the remaining debt and pocketing a massive profit on their small initial equity investment. When it works, it looks like financial genius, but it is a strategy that plays with fire. Consider the tragic story of Toys R Us. For decades, it was a category killer, a beloved brand that dominated the toy market. In 2005, a consortium of private equity firms, including KKR and Bain Capital, took the company private in a $6.6 billion leveraged buyout. They put up just $1.3 billion of their own capital and loaded the company with $5.3 billion in new debt. The annual interest payments on this debt were astronomical, often exceeding $400 million per year. This was a massive tax on the business. Every dollar that went to the banks was a dollar that couldn't be used to renovate stores, to build a competitive e-commerce website, or to lower prices to compete with Walmart and a rising Amazon. The company was trapped in a financial straitjacket. As consumer behavior shifted online, Toys R Us needed to adapt. It needed to invest heavily in technology and logistics, but it couldn't. The mountain of debt from the LBO starved it of the very capital it needed to survive. The 99% mindset, the LBO mindset, saw the company not as a living, breathing business that needed to adapt, but as a collection of cash flows to be funneled to creditors and equity sponsors. The focus was on extracting value, not building it. The result was inevitable. In 2017, Toys R Us, unable to service its massive debt load, declared bankruptcy. A great American brand was destroyed, and tens of thousands of jobs were lost. This is the antithesis of the Buffett approach. The 99% sees debt as a clever shortcut, an amplifier of returns. They fail to see that it is also an amplifier of fragility. It removes a company's margin for error, its ability to withstand shocks, its capacity to reinvest for the long term. They are playing a game of Russian roulette. For every one time they succeed and look like geniuses, there are countless other instances where the strategy leads to ruin, demonstrating the disastrous consequences of prioritizing financial engineering over sound business practice and long-term financial health. The direct financial connection between a fortress balance sheet and superior investment returns is not theoretical. It is mathematically demonstrable and appears directly on a company's financial statements. A company with little to no debt possesses a tangible and massive financial advantage that compounds over time. Let's start with the income statement. The most obvious impact is on the line item interest expense. A company with zero debt has zero interest expense. A heavily leveraged company may be sending hundreds of millions or even billions of dollars to its creditors each year. This is a direct drain on profitability. Every dollar paid in interest is a dollar that does not flow down to net income, the pool of profit that belongs to the shareholders. This means that, all else being equal, a debt-free company will have higher net profit margins and a higher return on its assets. But the true power is revealed on the cash flow statement. Cash is the lifeblood of a business, and debt is a constant drain on that lifeblood. The debt-free company's cash from operations is entirely its own. It can be used for three value-creating purposes: reinvesting in the business to fuel organic growth, acquiring other companies, or returning capital to shareholders through dividends and share buybacks. The leveraged company, however, has a non-negotiable first claim on its cash: servicing its debt. Principal and interest payments must be made, on time, every time, regardless of the operating environment. This creates a dramatic divergence in financial destinies during an economic downturn. Consider two identical companies. Company A has no debt. Company B is heavily leveraged. A severe recession hits, and both companies' revenues fall by 30%. Company B, the leveraged one, is now in a panic. Its lower cash flow may be insufficient to cover its fixed interest payments. It is forced into survival mode, firing employees, slashing its research and development budget, and selling assets to raise cash. It is playing defense. Company A, the debt-free one, is in a completely different position. While its profits are down, it faces no risk of default. It is not beholden to any bank. It sees the crisis not as a threat, but as an opportunity. While its competitors, like Company B, are in disarray, Company A can go on offense. It can hire the talented engineers that Company B just laid off. It can gain market share by maintaining its marketing budget while others are cutting back. Most powerfully, it can use its pristine balance sheet to acquire the assets of its distressed competitors like Company B for pennies on the dollar. This is exactly what Berkshire Hathaway has done time and time again, most famously during the 2008 financial crisis when it acted as a lender of last resort to giants like Goldman Sachs and General Electric, extracting incredibly favorable terms. This ability to play offense during a crisis is a direct result of avoiding debt during the good times. Over a full economic cycle, this advantage is immense. The debt-free company not only survives the downturns, but emerges from them stronger, with a larger market share and a portfolio of newly acquired, cheap assets. The leveraged company is lucky just to survive, often emerging crippled and diminished. This is the essence of long-term wealth preservation and creation. The fortress balance sheet is not just a defensive shield, it is the ultimate offensive weapon. The second pillar of Buffett's philosophy on debt goes beyond simple risk management. It posits that the very need for debt is often a symptom of a flawed or inferior business model. A truly wonderful business, one with a durable competitive advantage, what Buffett calls an economic moat, should be a fountain of cash. It should generate such prodigious profits from its own operations that it has more than enough capital to fund its growth, innovate its products, and fend off competitors, all without ever having to ask a banker for a loan. In this worldview, a company's balance sheet becomes a powerful X-ray into the quality of its underlying business. A clean balance sheet suggests a self-funding engine of value creation. A debt-laden balance sheet suggests a business that is constantly struggling, one that consumes more cash than it produces. The quintessential story that cemented this belief in Buffett's mind is the 1972 acquisition of See's Candies. At the time, Buffett was still largely practicing the cigar butt style of investing he learned from his mentor, Benjamin Graham, buying statistically cheap, often mediocre companies. See's Candies was different. It was a beloved, family-owned chocolate company on the West Coast, and it was not statistically cheap. The asking price was $25 million, which was 3 times its book value. Buffett initially balked at the price. It was his partner, Charlie Munger, who pushed him to reconsider, arguing that they should be willing to pay a premium for a truly high-quality business. They investigated further, and what they discovered became the blueprint for their future success. See's Candies possessed a powerful economic moat built on its brand. Generations of Californians had grown up with See's, associating it with holidays, celebrations, and quality. This brand loyalty gave See's tremendous pricing power. Every year, they could raise the price of their chocolates by a small amount to cover inflation and increase profits. and their loyal customers wouldn't even think of switching to a cheaper competitor. The business model was a financial marvel. It required very little capital. They rented their retail locations, they didn't need to spend heavily on research and development, and customers paid for their product in cash at the counter. But here was the masterstroke. The business had a negative working capital cycle. The biggest sales season was around Christmas. See's would sell millions of dollars worth of gift boxes in November and December, collecting cash from customers immediately. However, they wouldn't have to pay for the raw materials like sugar and chocolate or for much of the seasonal labor until January or February of the next year. This meant that for a significant portion of the year, their customers and suppliers were effectively financing their operations. The business didn't just fund itself, it generated a float of cash that Buffett could use for other purposes. Since acquiring See's for $25 million, it has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that was used to buy other wonderful businesses. And it achieved this phenomenal growth without ever needing a single dollar of debt. See's Candies was the ultimate self-funding engine. It was an epiphany for Buffett. He realized that the business that gushes cash is infinitely superior to the business that consumes it. The need to constantly borrow money wasn't just a financial choice. It was a red flag, a signal that the underlying economics of the business were weak. A company that has to borrow to fund its day-to-day operations or its expansion plans is admitting that its own core business isn't profitable enough to stand on its own 2 feet. It's a confession of mediocrity. From that point forward, the search for companies with pristine balance sheets became synonymous with the search for wonderful businesses of the highest quality. The underlying psychological principle at play here is the profound difference between a scarcity mindset and an abundance mindset. These are not just New Age buzzwords. They are cognitive frames that dictate every decision a business makes. A company that relies on debt operates from a deep-seated scarcity mindset. Its entire worldview is built around the idea that we don't have enough. We don't have enough cash to fund our new factory, so we must borrow. We don't have enough capital to survive a downturn, so we need a credit line. This scarcity mentality permeates the entire corporate culture. Management becomes obsessed with managing constraints. Their days are filled with calls to bankers, with poring over debt covenants, with worrying about the next interest payment. Their strategic vision shrinks to the short term. They ask not what is the best long-term decision for the business, but what decision will allow us to satisfy our creditors this quarter. This creates a culture of fear and conservatism in the worst sense of the word, a paralysis that prevents bold, innovative moves. Now contrast this with a business like See's Candies or Google, which operates from an abundance mindset. Their worldview is, we generate so much cash, our primary problem is figuring out how to wisely reinvest it. This is a fundamentally different and more empowering problem to have. Management is liberated from the tyranny of the creditor. Their minds are free to focus on long-term value creation. They can think about expanding their economic moat, delighting their customers, and exploring new, ambitious projects. This abundance of internally generated capital allows them to take calculated risks that a debt-laden company could never dream of. They can afford to fail. Google's famous moonshot projects, many of which don't pan out, are only possible because the core search business is a fire hose of cash. A leveraged company cannot afford a single moonshot. Its trajectory is fixed and fragile. This psychological shift from scarcity to abundance also changes how a company interacts with its stakeholders. The scarcity-driven company is often forced into a zero-sum game, squeezing its suppliers for better terms, cutting employee benefits, and reducing customer service quality, all to scrape together enough cash to pay the bank. The abundance-driven company can afford to play a positive-sum game. It can pay its suppliers on time, invest in its employees, and over-deliver on customer service, creating a virtuous cycle of goodwill that further strengthens its brand and its economic moat. As an investor, when you analyze a company's balance sheet, you are getting a direct window into its corporate psyche. A history of heavy borrowing tells you that the company's leadership likely operates from a place of scarcity. A long history of low debt and high cash generation is a strong indicator of an abundance mindset. And over the long term, it is the companies that operate from a position of financial and psychological abundance that have the freedom and the resources to innovate, to dominate their markets, and to create staggering amounts of shareholder value. To apply this insight, you need a mental model for identifying these self-funding engines. The most effective blueprint for this is a qualitative framework that sits on top of the balance sheet analysis, the economic moat assessment. The goal is to move beyond the numbers and understand the fundamental business characteristics that eliminate the need for debt in the first place. This analysis consists of 3 critical steps. Step 1. Identify the source and durability of the company's economic moat. A moat is a sustainable competitive advantage that protects a business from competitors, much like a real moat protects a castle. There are several primary sources of moats. Is it a powerful brand, like Coca-Cola or Apple, that commands pricing power and customer loyalty? Is it the network effect, where the service becomes more valuable as more people use it, like Facebook or Visa? Is it high switching costs, which make it painful or expensive for customers to change providers, like the software used by large corporations? Or is it a low-cost advantage, driven by scale or a unique process, like Costco or Geico? A business with a wide, deep moat can generate high returns on its capital for a very long time because its profits are protected from competition. It's this protection that allows it to be a self-funding engine. Step 2. Analyze the company's cash conversion cycle. This is a crucial, often overlooked aspect of business quality. The cash conversion cycle measures how long it takes for a company to turn its investments in inventory and other resources into cash from sales. A brilliant business has a short or even negative cycle. Consider a company like Amazon. It often sells a product to a customer and receives the cash instantly via credit card. However, due to its immense bargaining power, it might not have to pay its supplier for that same product for 60 or 90 days. For that 2 or 3 month period, Amazon has an interest-free loan from its suppliers. This is a powerful source of self-funding. You should look for businesses that get paid by their customers before they have to pay their suppliers. It's a clear sign of a dominant market position. Step 3. Assess the capital intensity of the business. This goes back to Buffett's painful lesson with the Berkshire textile mills. Some businesses are inherently capital-intensive. They must constantly spend enormous sums on plants, property, and equipment just to stay competitive. Think of airlines, which need to buy new planes, automakers, which need to retool factories, or oil and gas companies, which must constantly drill new wells. These businesses are financial tapeworms. Even if they are profitable, their cash gets consumed by capital expenditures. A truly wonderful business has low capital intensity. A software company like Microsoft can create a new product with the primary cost being developer salaries, and then it can sell that product millions of times with near-zero marginal cost. A company built on a brand, like See's Candies, needs to maintain its stores, but it doesn't need to spend billions on heavy machinery. By running a potential investment through this 3-step blueprint, evaluating its moat, its cash conversion cycle, and its capital intensity, you can develop a deep understanding of its ability to be a self-funding engine. A company with a wide moat, a negative cash conversion cycle, and low capital needs is the trifecta. It is a business that is almost guaranteed to gush cash, making debt not just unnecessary but utterly illogical. This qualitative analysis is what separates a true intelligent investor from a mere number cruncher. The path of the 99% is to ignore these fundamental characteristics and fall into what can be called the capital-intensive trap. Investors and managers in this trap are seduced by the appearance of growth and importance, failing to see the brutal economics lurking beneath the surface. There is no better example of this than the airline industry, an industry that Warren Buffett has famously and repeatedly savaged. At first glance, airlines seem like impressive businesses. They are household names, they are essential to the global economy, and they operate magnificent, expensive pieces of technology. But when you apply the economic moat blueprint, the illusion shatters. First, airlines have virtually no economic moat. The service is largely a commodity. Most travelers choose their flight based on two factors: price and schedule. There is very little brand loyalty. This leads to ferocious, cutthroat price competition that obliterates profit margins. Second, their cash conversion cycle is nothing special. They get paid in advance, which is good, but they face immense immediate cash outlays for fuel, labor, and airport fees. Third, and most critically, the industry's capital intensity is nightmarish. An airline's primary assets are airplanes, which cost hundreds of millions of dollars each and have a limited lifespan. They are in a constant, ruinously expensive cycle of having to upgrade their fleet. This means that even in a good year, a huge portion of their operating cash flow is immediately consumed by capital expenditures just to maintain the status quo. The result of these terrible economics is that airlines are chronically unable to fund their own operations. They are perpetually reliant on external capital. They must borrow billions from banks to finance new aircraft. They are constantly at the mercy of the capital markets. This permanent need for debt makes them extraordinarily fragile. A slight increase in the price of jet fuel can wipe out their profits. A recession that reduces travel demand can push them to the brink. A labor strike can ground their fleet and send them into a liquidity crisis. It's no surprise that the history of the airline industry is a graveyard of bankruptcies. American Airlines, United Airlines, Delta Airlines, all have gone through Chapter 11, some more than once. Buffett himself fell into this trap in 1989 when he invested in preferred stock of U.S. Airways. He later called the investment a huge mistake, soured by the industry's fundamental flaws. He lamented that if a far-sighted capitalist had been at Kitty Hawk, he would have done his successors a huge favor by shooting Orville down. The 99% of investors look at an airline and see a powerful brand and growing revenues. They get excited by the story, but they fail to do the rigorous financial analysis required to see the capital-intensive trap. They don't see the non-existent moat, the brutal competition, and the endless need for new capital that necessitates a permanent reliance on debt. They are investing in a business that is structurally designed to consume cash, not produce it. This is the ultimate antithesis of a self-funding engine, and a stark illustration of a flawed business model that should be avoided by any practitioner of long-term investing. The direct financial connection of the self-funding engine principle is measured by a metric far more important than the bottom-line net income reported on the income statement. That metric is owner earnings, or its more common proxy, free cash flow. Warren Buffett introduced the concept of owner earnings in his 1986 letter to shareholders. He defined it as a company's net income, plus non-cash charges like depreciation and amortization, minus the average annual amount of capital expenditures required to maintain the business's long-term competitive position. In simpler terms, free cash flow is the cash a company generates after paying for all its operations and its necessary capital investments. This is the real, spendable cash profit that is left over for the owners of the business at the end of the year. This is the cash that can be used to pay dividends, buy back stock, or make acquisitions. It is the ultimate source of a company's intrinsic value. A self-funding business with a wide economic moat and low capital intensity is a free cash flow machine. Let's look at a real-world example. A company like Moody's, the credit rating agency, has a phenomenal business model. It has a powerful duopoly with Standard & Poor's, a wide moat, and its business requires very little capital, just office space, computers, and smart analysts. As a result, it converts an incredibly high percentage of its revenue into free cash flow. A capital-intensive business like a major airline, on the other hand, might report $1 billion in net income, which looks impressive. But then you look at its cash flow statement and see that it had to spend $2 billion on new planes that year just to stay competitive. Its free cash flow is actually negative $1 billion. Despite reporting a profit, the business actually consumed cash. As an investor, analyzing the historical free cash flow of a company is one of the most important steps in your financial analysis. A company that consistently generates strong and growing free cash flow, and which carries little debt, is proving that it has a superior business model. It is demonstrating its ability to fund its own growth. A company with erratic or negative free cash flow, especially when paired with a rising debt load, is screaming that its business is fundamentally weak. It is on a financial treadmill, running faster and faster just to stay in the same place. By focusing on free cash flow instead of reported earnings, and by demanding that this cash flow is generated without the assistance of leverage, you align yourself with the economic reality of the business. You are investing in a true value creator, not a capital consumer. This is the financial signature of business quality, the ultimate proof that you have found a self-funding engine capable of compounding your wealth for decades to come. The third pillar of Buffett's anti-debt doctrine exposes a more insidious danger, one that goes beyond financial statements and strikes at the very heart of a company's ability to operate and innovate. This is the principle of the tyranny of the creditor. When a company takes on significant debt, it isn't just a financial transaction, it's a transfer of power. A portion of the company's sovereignty is handed over to the lenders. These creditors, be they banks or bondholders, become a powerful, unseen force in the boardroom, influencing decisions and constraining management's freedom of action. Their interests are not aligned with the long-term interests of shareholders. A shareholder wants the company to take calculated risks, to innovate, and to grow its intrinsic value over decades. A creditor has a much simpler and more brutal objective: to get their money back, on schedule, with the agreed-upon interest. This fundamental conflict of interest means that debt can hijack a company's executive decision-making, forcing it into short-term value-destroying behavior, especially during times of crisis. There is no more terrifying illustration of this principle than the near implosion of the hedge fund Long-Term Capital Management, or LTCM, in the fall of 1998. While not a Berkshire investment, the story is a masterclass in the perils of leverage, and Buffett himself was called in at the 11th hour to potentially lead a rescue. LTCM was a fund run by a dream team of Wall Street's brightest minds, including John Meriwether, the former head of bond trading at Salomon Brothers, and two Nobel Prize-winning economists, Myron Scholes and Robert Merton. They had developed complex mathematical models that they believed could identify tiny temporary pricing discrepancies in global bond markets. Their strategy was to make thousands of these trades, known as arbitrage, to capture these small spreads. The problem was that the profits on any single trade were minuscule. To generate the spectacular returns their investors expected, they had to use an absolutely breathtaking amount of leverage. They borrowed enormous sums of money, at times having over $100 billion in assets on a capital base of just a few billion. Their leverage ratio was in excess of 25 to 1, and on some specific trades, it was well over 100 to 1. For a few years, the strategy worked flawlessly, and the partners at LTCM became fabulously wealthy. They were the kings of the financial universe. But they had made a pact with the devil of debt. In August of 1998, an event occurred that their models had deemed statistically impossible. Russia defaulted on its domestic debt. This triggered a global flight to quality, as terrified investors around the world sold off riskier bonds and piled into the safest U.S. Treasury bonds. The tiny pricing discrepancies that LTCM was betting on to close suddenly widened dramatically. Their models were breaking. As their positions moved against them, they began to suffer catastrophic losses. And here, the tyranny of the creditor began. Their lenders, the biggest banks on Wall Street, made margin calls, demanding more collateral to back the loans. But LTCM was running out of collateral. The lenders, gripped by fear, were no longer partners. They were adversaries, threatening to seize and liquidate LTCM's assets to get their money back. This forced selling by the banks would have created a domino effect, crashing global markets. The situation was so dire that the Federal Reserve Bank of New York had to intervene, orchestrating a $3.6 billion bailout by a consortium of Wall Street banks to prevent a systemic meltdown. Buffett was asked to consider participating but ultimately declined. The story of LTCM is the ultimate cautionary tale. It shows how extreme leverage can take certified geniuses and turn them into frightened men, completely at the mercy of their creditors. Their supposed brilliance was irrelevant. Their Nobel Prizes were worthless. Once they lost control of their own financial destiny by taking on so much debt, their fate was in the hands of panicked bankers. This is why Buffett so often says he is unwilling to risk what he has and needs for something he doesn't have and doesn't need. He is unwilling to trade a good night's sleep for a few extra basis points of return. The tyranny of the creditor ensures that anyone who relies on heavy leverage will, sooner or later, have many sleepless nights. The psychological principle that explains this dangerous dynamic is a combination of the agency problem and its toxic byproduct, short-termism. In corporate finance, an agency problem arises when there is a conflict of interest between the management of a company, the agents, and its owners, the principals or shareholders. Debt introduces a third, powerful party into this relationship, the creditor. And the creditor's interests create a massive, distorting agency problem. Management is now forced to serve two masters with conflicting goals. Shareholders want long-term growth, creditors want short-term safety and repayment. In any moment of stress or uncertainty, the creditor's voice is always louder, because they hold the power of default. This power is formalized through legal documents called debt covenants. These are rules and restrictions that the borrower must abide by, or else the loan goes into default. Covenants can dictate a company's minimum cash levels, restrict the amount it can spend on capital expenditures, prohibit it from making acquisitions, or even prevent it from paying a dividend to its own shareholders. These covenants are the legal chains of creditor tyranny. They systematically force management into a short-term mindset. Imagine a company that has a brilliant opportunity to invest in a new technology that will secure its market leadership for the next decade. However, this investment would cause the company to temporarily violate a debt covenant. The rational, long-term decision for shareholders is to make the investment. But management, fearing a default, is forced to pass on the opportunity. The company's future is sacrificed on the altar of short-term covenant compliance. This is not a hypothetical scenario. It happens every day in the corporate world. Debt creates a state of corporate paralysis, precisely when agility and boldness are most needed. During a recession, a debt-free company is free to act, to invest, to acquire. A leveraged company is frozen, its every move scrutinized by its lenders. Its management is no longer focused on beating the competition. They are focused on generating reports for the bank. This forced short-termism is a psychological trap. Over time, it seeps into the culture of an organization. The entire company starts to think in quarterly increments, from one interest payment to the next. The grand, long-term vision is lost. Innovation withers. The company becomes a shadow of its former self. Its primary purpose shifting from creating value for customers and shareholders to simply feeding the insatiable appetite of its creditors. By avoiding companies with significant debt, an investor is not just selecting for financial strength, they are selecting for a culture of long-term thinking and strategic freedom. They are betting on a management team that is empowered to act in the best interests of the owners, free from the paralyzing influence of the agency problem created by debt. The mental model for internalizing this principle and using it to make better decisions is the optionality framework. Optionality is a concept borrowed from finance, but it has profound strategic implications. It refers to the value of having choices, of possessing the flexibility to act or not act in response to future events. A company with no debt and a balance sheet flush with cash has maximum optionality. A company burdened by debt has very little. An intelligent investor learns to see this optionality as a massive, hidden asset that doesn't appear on any financial statement. The blueprint for applying the optionality framework has 3 parts. Step 1. When analyzing a company, create an opportunity inventory. Brainstorm a list of all the potential strategic moves the company could make over the next 5 years to create value. This could include launching a major new product line, entering a new geographic market, acquiring a key competitor, engaging in a price war to drive out weaker rivals, or buying back a significant portion of its own shares during a market crash. Think creatively and aggressively, as if you were the CEO. Step 2. For each opportunity on your list, perform a debt constraint analysis. Go through the list one by one and ask a simple question. How would a heavy debt load and restrictive covenants impact the company's ability to execute this move? You'll find the impact is almost always negative. A company with tight covenants can't just decide to make a large acquisition. A company with high interest payments can't afford the short-term profit hit of a price war. A company facing a liquidity crunch is more likely to be issuing shares, not buying them back. Debt systematically strips away a company's options, leaving it with only one path, the one dictated by its lenders. Step 3. Assign a qualitative value to this strategic flexibility. This is the most important step. While you can't put a precise dollar figure on it, you must consciously recognize that the optionality held by a debt-free company is an enormous competitive advantage. It's the ability to say yes to a game-changing opportunity when all your leveraged competitors are forced to say no. It's the power to zig when the entire industry is forced to zag. This optionality value is most precious during times of chaos and uncertainty. In a stable, predictable world, flexibility might not seem that important. But the world is never stable and predictable for long. When the inevitable crisis hits, the companies with the most options are the ones that not only survive, but emerge as the new leaders. By making this framework a core part of your investment process, you train your mind to look beyond the static numbers on a page and to see the dynamic reality of a business's strategic position. You start to value resilience and flexibility as much as you value growth and profitability. You are no longer just a financial analyst. You are a corporate strategist, and you understand that the greatest asset of all is the freedom to choose your own destiny, a freedom that is the first casualty of the tyranny of the creditor. The opposite of the optionality framework, the path of the 99%, leads to a devastating outcome known as the forced selling death spiral. This is the tragic story of a company that, because of its debt, loses control at the worst possible moment and is forced to sell its most valuable assets for a fraction of their worth. This is how temporary business problems become permanent impairments of capital. Let's paint a picture of this all-too-common scenario, using a hypothetical company in the oil and gas industry, a notoriously cyclical sector. During a boom time, when oil prices are high, let's call our company Ambitious Drillers, Inc. Flush with optimism, they decide to accelerate their growth. They go to the banks and borrow billions of dollars to acquire new drilling rights and purchase new equipment. Their balance sheet becomes bloated with debt, but as long as oil prices stay high, their cash flow is strong enough to make the interest payments. Their CEO is hailed as a visionary on the financial news channels. Then, the inevitable happens. The price of oil collapses due to a global recession or a supply glut. The cash flow of Ambitious Drillers plummets. Suddenly, they are in breach of their debt covenants. The banks, now terrified of losing their money, descend. The friendly loan officers are replaced by stern workout specialists. They demand that Ambitious Drillers raise cash immediately to pay down its debt. But how? The company is losing money, and the capital markets are closed to them. They have only one option: sell assets. But what assets can they sell? The only things that have any value in a depressed market are their crown jewels, their best, most productive oil fields. So they are forced to put their most valuable properties up for sale at the very bottom of the oil cycle. And who is on the other side of the table, ready to buy? It's their competitor, let's call them Prudent Energy Corp. Prudent Energy, having followed a Buffett-like approach, maintained a fortress balance sheet during the boom years. They resisted the temptation to use leverage. Now, with cash on hand and no debt to service, they are in a position of immense power. They can buy the crown jewel assets of Ambitious Drillers for 30 cents on the dollar. This is the ultimate destruction of shareholder value. Ambitious Drillers is forced to sell its future just to survive the present. It emerges from the crisis a hollowed-out shell of its former self, having permanently transferred a massive amount of wealth to its more prudent competitor. This is the death spiral. The initial debt created the vulnerability. The downturn triggered the crisis. the creditors forced the sale of the best assets. This weakened the company further, making it even harder to recover. The 99% of managers and investors who embrace leverage fail to think through this second and third order consequence. They focus on the best-case scenario of amplified returns and ignore the catastrophic potential of the forced sale. They forget that the person who can't walk away from the negotiating table always gets the worst deal. A company at the mercy of its creditors has no choice but to accept a terrible deal, sealing its own fate in a downward spiral from which it may never recover. The direct financial connection of this principle lies in the concepts of risk management and the preservation of enterprise value. The true value of a company is not just a multiple of its current year's earnings. It is the present value of all its future cash flows, discounted back to today. A key component of this calculation is the discount rate, which reflects the riskiness of those future cash flows. A company with high debt has riskier cash flows. There is a greater probability that those cash flows will be interrupted or completely eliminated by bankruptcy. Therefore, a higher discount rate must be used, which results in a lower calculated enterprise value. Furthermore, the tyranny of the creditor directly impacts a company's credit rating, which is assigned by agencies like Moody's and Standard & Poor's. A company with high leverage will have a lower credit rating, meaning it is considered a riskier borrower. This lower rating leads to a higher interest rate on any new debt it tries to issue, creating a vicious cycle. The high debt leads to a downgrade. The downgrade leads to higher interest costs. The higher interest costs weaken the company's financial position, which can lead to another downgrade. It's a feedback loop of financial distress. But the most profound financial impact is the asymmetric nature of value creation and destruction during a crisis. The company that is forced to sell its assets at the bottom of the market doesn't just lose the value of that asset. It loses all the future cash flow that asset would have generated. The company that buys that same asset at the bottom gets a double win. They acquire it for a cheap price, and they get to enjoy all of its future cash flows during the subsequent recovery. Over a full economic cycle, the transfer of wealth from the leveraged to the unleveraged can be staggering. This is the hidden engine of wealth creation for Berkshire Hathaway. It's a strategy of patient risk management during the good times, followed by aggressive opportunism during the bad times. This is only possible because they have avoided the tyranny of the creditor. By refusing to take on debt, they ensure that they are always the ones sitting at the table with the cash, ready to dictate terms, never the ones forced to accept whatever is offered. This is the ultimate financial manifestation of power, the power to act when others are paralyzed, and the power to buy when others are forced to sell. It is a financial advantage so immense that it can turn a decade of merely good returns into a lifetime of extraordinary ones. The fourth pillar of Buffett's anti-debt philosophy is a direct assault on one of the most sacred cows of modern academic finance, the theory of optimal capital structure. This is the idea taught in every MBA program that there is a perfect, scientifically determinable mix of debt and equity that a company should use to finance itself. The theory suggests that by adding a certain amount of good debt, a company can lower its overall cost of capital and thereby maximize its value. To Buffett, this entire concept is a dangerous delusion. It is a product of abstract models that ignore the messy, unpredictable realities of the real world. He believes that trying to fine-tune a company's leverage is like picking up pennies in front of a steamroller, a strategy that generates small, consistent gains until one day it leads to a sudden and total catastrophe. The story that best encapsulates this clash of worldviews is Buffett's reluctant role in the Salomon Brothers scandal of 1991. Salomon was the embodiment of the Wall Street ethos. It was a swaggering, aggressive bond-trading firm where risk-taking was celebrated and leverage was the air they breathed. Their business model was to borrow billions of dollars, often at leverage ratios of 30-to-1 or more, to make tiny profits on the spread between different bonds. They were the high priests of financial engineering and complex arbitrage. Berkshire Hathaway was a major shareholder in Salomon, and Buffett sat on its board. In 1991, a massive scandal erupted. It was discovered that a rogue trader at Salomon had been submitting false bids in U.S. Treasury auctions to illegally corner the market. The scandal was a direct threat to the firm's very existence. Their reputation was shattered, and their biggest client, the U.S. government, was threatening to ban them from doing business, a move that would have been a death sentence. The firm was bleeding capital, and its lenders were panicking. With Salomon on the brink of collapse, its CEO resigned, and Warren Buffett, in a move that shocked the financial world, agreed to step in as interim CEO to save the firm. What he found was a culture built on a perilous foundation of leverage and arrogance. In his famous testimony before the U.S. Congress, he laid out his own philosophy, a stark contrast to the Salomon way. He said, "Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless." His focus was not on maximizing profits, but on restoring trust and ensuring survival. The Salomon Brothers crisis was a microcosm of the dangers of a business model built on leverage. The firm's massive profits in the good years were predicated on a fragile system that required trust, liquidity, and stable markets. The moment one of those pillars, trust, was removed, the entire edifice threatened to collapse. The huge amounts of debt meant they had no margin for error. The scandal wasn't just a business problem, it was an existential threat because their leverage was so extreme. This experience reinforced Buffett's deep-seated skepticism of Wall Street's obsession with so-called optimal leverage. He saw that the complex models used to justify this leverage were fatally flawed, because they could never account for the one thing that matters most: the risk of a sudden, unforeseen event that causes the entire system to break down. The underlying psychological biases that fuel this delusion of optimal leverage are powerful and pervasive. The first is overconfidence bias. The executives, bankers, and academics who champion leverage are often incredibly intelligent people with impressive credentials. They believe their sophisticated models give them a true understanding of risk. They are confident that they can manage the dangers of debt, that they can see a crisis coming and adjust their positions accordingly. They systematically underestimate the role of randomness and uncertainty in the world. This is perfectly illustrated by what the philosopher Nassim Nicholas Taleb calls the turkey problem. Imagine you are a turkey. Every day for 1,000 days, a friendly human comes and feeds you. With each passing day, your confidence grows. You build a sophisticated statistical model based on this extensive dataset, which concludes with near certainty that the human is your friend and that your future is secure and prosperous. Your model projects an ever-increasing supply of food. Then, on day 1001, the day before Thanksgiving, the human arrives, but not with food. The turkey's entire belief system, built on 1,000 days of data, is catastrophically and fatally revised. The models used to calculate optimal capital structure are like the turkey's model. They are typically based on historical market data from the last few decades. They show that, historically, leverage has boosted returns, and that market downturns have been manageable. But these models are completely blind to the possibility of a black swan event, a Thanksgiving day for the financial markets. An event like the 1987 crash, the LTCM crisis, or the 2008 financial meltdown. These events are, by their nature, unpredictable and outside the scope of the models. When a black swan arrives, the supposedly optimal leverage becomes instantly and fatally suboptimal. The overconfidence of the financial engineers is shattered, and the system collapses. The second bias is a failure to appreciate nonlinearity. Most people think in linear terms. More of a good thing is always better. If a little bit of leverage boosts returns, then a little more must be even better. But the risk of debt is not linear. A company with a little debt is slightly riskier. But a company that moves from a 10-to-1 leverage ratio to a 20-to-1 ratio has not just doubled its risk, it has increased it exponentially. It has moved much closer to the cliff edge, where even a small gust of wind can send it plummeting. Buffett's simple, debt-averse approach is a powerful antidote to these biases. He doesn't pretend to know what the future holds. He assumes the possibility of a black swan event is always present. His strategy is not to optimize for the most likely outcome, but to ensure survival in the worst possible outcome. He is building an ark, not a speedboat. The applied mental model to counter this dangerous academic thinking is the foundational principle of all value investing, the margin of safety. Popularized by Benjamin Graham, this concept is deceptively simple but profoundly powerful. It is the idea that you should never pay the full price for anything. Whether it's a stock or a business decision, you must always leave a substantial cushion, a buffer for error, bad luck, or misjudgment. When buying a stock, the margin of safety is the difference between the price you pay and your conservative estimate of its intrinsic value. If you believe a company is worth $100 per share, you don't buy it at $95. You wait until you can buy it at $60. That $40 difference is your margin of safety. It protects you if your valuation was too optimistic, or if the company encounters unexpected problems. A pristine balance sheet is the application of the margin of safety principle to a company's operations. It is the company's own internal buffer against the unpredictable tides of the economy. A company with a fortress balance sheet can withstand a surprising drop in sales, a sudden spike in costs, or a freeze in the credit markets. It doesn't need its forecasts to be perfect. A company that is leveraged to its optimal capacity has no margin of safety. It is a finely tuned machine that requires everything to go exactly as planned. The slightest hiccup, a delayed product launch, a lost customer, a small recession, can throw the entire system into chaos. The blueprint for applying this is to make the margin of safety a non-negotiable criterion in your financial analysis. Step 1. Just as you would calculate a conservative intrinsic value for a stock, calculate a survival value for the business's operations. How much could revenues fall before the company starts losing money? Step 2. Analyze the balance sheet as the operational margin of safety. Does the company have enough cash and borrowing capacity to survive a 2-year period where its revenues are 30% below your expectations? If the answer is no, it has no margin of safety. Step 3. Reject precision and embrace robustness. Be deeply skeptical of any management team or analyst who claims to have found the quote optimal level of debt. Recognize that this is a sign of hubris. Instead, look for management teams that speak in terms of fortress balance sheets, surviving any storm, and financial discipline. Their language will reveal their mindset. By demanding a margin of safety in both the price you pay and the financial structure of the businesses you own, you are building a portfolio designed for resilience. You are acknowledging the limits of your own forecasting ability and the inherent uncertainty of the future. You are choosing the robust, common-sense wisdom of the intelligent investor over the fragile, pseudoscientific arrogance of the financial engineer. The antithesis of the margin of safety, and the trap that the 99% falls into, is the obsessive chase for a single, often misleading metric, return on equity, or ROE. ROE is calculated by dividing a company's net income by its shareholders' equity. On the surface, it seems like a great measure of profitability. A high ROE suggests that management is doing a fantastic job of generating profits from the capital that shareholders have invested. Because of this, many CEOs and boards of directors have their compensation tied directly to ROE targets. This creates a perverse incentive. One of the quickest and easiest ways to artificially inflate ROE is not by improving the business's operations, but by manipulating its capital structure. Look at the formula. ROE equals net income/equity. If you want to make ROE go up, you can either increase the numerator, net income, or decrease the denominator, equity. Increasing net income is hard. It requires innovation, efficiency, and beating the competition. Decreasing equity is easy. A company can simply borrow money, take on debt, and use that money to buy back its own shares. When the shares are bought back, the amount of shareholders' equity on the balance sheet decreases. The denominator in the ROE formula gets smaller, and, like magic, the ROE shoots up, even if the underlying business hasn't improved at all. This is financial engineering at its most deceptive. The company looks more profitable on this one key metric, but it has become far more risky and fragile. It has traded the robustness of its equity cushion for the brittleness of debt. The big Wall Street banks in the years leading up to the 2008 financial crisis were masters of this game. They reported stellar and consistently growing ROE figures, and their executives were paid massive bonuses as a result. But this performance was built on a foundation of sand. They were taking on astronomical amounts of leverage, in some cases over 30-to-1, to magnify their returns from a portfolio of what turned out to be toxic mortgage-backed securities. They looked like geniuses, right up until the moment the housing market turned. Then, their high ROE business model was exposed as an incredibly risky bet that brought the entire global financial system to its knees. The 99% of investors, including many so-called professionals, get seduced by metrics like ROE. They see a high number and assume it reflects high business quality, without doing the deeper work of analyzing the balance sheet to see asterisks how that return is being generated. They fail to distinguish between a return generated by genuine operational excellence and a return generated by reckless financial leverage. Buffett, the intelligent investor, knows that the quality of the return is far more important than the quantity. A 15% return on equity generated with zero debt is infinitely superior to a 20% return on equity generated with massive leverage. One is sustainable and robust, the other is a fragile illusion destined to shatter. The direct financial connection here is the crucial distinction between acceptable risk and, quote, tail risk. Tail risk refers to the risk of a rare, low-probability event that has an extremely large, negative impact. It's the black swan, the Thanksgiving day for the turkey. The financial models that advocate for optimal leverage are notoriously bad at accounting for tail risk. They might show that a leveraged company will produce slightly better returns 95% of the time, but they ignore the 5% of the time when a market panic or a severe recession will cause that leveraged company to go bankrupt, resulting in a 100% loss for its shareholders. An unleveraged company might produce slightly lower returns in the good times, but its risk of a 100% loss from a debt-induced bankruptcy is zero. Over a multi-decade investing career, avoiding that single, catastrophic wipeout is mathematically far more important than squeezing out a few extra percentage points of return in the good years. Compounding works wonders, but it has one fatal enemy: the interruption caused by a massive loss. A portfolio that earns a steady 10% per year will end up with far more money than a portfolio that earns 20% for 5 years and then loses 50% in the 6th. Avoiding the big loss is the most important rule of long-term wealth preservation. This is a concept that is often misunderstood. The academic theory that supports optimal leverage, the Modigliani-Miller theorem, is based on a series of assumptions that are demonstrably false in the real world, such as the absence of taxes, the absence of bankruptcy costs, and the assumption that managers will always act in shareholders' best interests. In the real world, bankruptcy is incredibly costly, and its possibility should be avoided at all costs. By rejecting the delusion of optimal leverage and embracing the margin of safety, Buffett is making a clear, quantitative trade-off. He is consciously choosing to insulate his portfolio from the devastating impact of tail risk. He is building a financial structure that is robust to the things he cannot predict. This is the ultimate form of risk management. It is an acknowledgement that the most important number in investing is not the potential upside, but the probability of survival. The fifth and final pillar translates this entire philosophy into a concrete, actionable strategy for the individual investor. It is the use of debt as a primary non-negotiable filter for stock market investing. In a world with thousands of publicly traded companies and an infinite amount of financial data, an investor needs an efficient way to separate the wheat from the chaff. Buffett uses the balance sheet as his first line of defense. By simply looking at a company's debt load first, he can immediately eliminate the vast majority of companies from consideration, allowing him to focus his deep analytical energy only on the small subset of businesses that meet his high standards of financial health and durability. This is not just a part of his process, It is the gateway to his entire analytical process. A company must pass this test before any further work is done. A perfect anecdote of this principle in action is Buffett's investment in the Washington Post Company in the early 1970s. At the time, the stock market was in a funk, and newspaper stocks were deeply out of favor. Most investors saw them as boring, old media companies. But Buffett, using his unique lens, saw something entirely different. He started, as always, with the financials. What he found was a fortress. The Washington Post Company had virtually no long-term debt. It was a self-funding engine, gushing cash from its dominant newspaper, which had a near-monopoly position in the nation's capital. This gave it immense pricing power, with both advertisers and readers. It had a deep and wide economic moat. But the story got even better. As he dug deeper, Buffett realized that the market was completely mispricing the company. The entire market capitalization of the company was around $80 million. Yet, when Buffett looked at the assets, he saw that the company owned not just the newspaper, but also several highly profitable network television stations, Newsweek magazine, and other properties. He conservatively estimated that the television stations alone were worth more than the entire $80 million market cap. The market was essentially giving him the world-famous newspaper, Newsweek, and all the other assets for free. This was a classic value investing opportunity, presenting an enormous margin of safety. But the key that unlocked this entire discovery was his initial filter. He was only looking at the Post in the first place because it met his stringent criteria for business quality and financial strength. Its pristine balance sheet was the signal that this was a company worth investigating further. It told him that the management, led by the brilliant Katharine Graham, was disciplined and focused on long-term value, not short-term financial engineering. He began buying the stock aggressively in 1973, and his investment in the Washington Post Company would become one of the most successful of his entire career, multiplying his initial investment over 100 times. This story is the perfect synthesis of his approach. The debt filter acts as a powerful screening tool, leading him to a high-quality business. Then his deep analysis of the business and its valuation uncovers a massive mispricing. It's a two-step process, but the first step, the balance sheet X-ray, is the one that makes the entire strategy efficient and effective. The psychological principle that makes this filtering approach so powerful is its use of a highly effective mental shortcut or heuristic to deal with complexity. The world of finance is a classic example of information overload. An investor is bombarded with a constant stream of news, earnings reports, analyst ratings, and economic data. The human brain cannot possibly process all of this information. To cope, it naturally seeks out shortcuts or simple rules of thumb to make decisions. The problem is that most investors use weak, unreliable heuristics. They might use price momentum as a shortcut. The stock is going up, so it must be a good company. Or they might use a simple valuation metric like the price-to-earnings ratio as their only guide, without understanding the context behind it. These are shortcuts that often lead to poor decisions. Buffett's use of debt as a primary filter is a far superior heuristic. It is a simple rule, but it is not simplistic. It is grounded in the deep, fundamental principles of business and risk we have been exploring. By asking the question, does this company have a pristine balance sheet? As the very first step, an investor can achieve a state of cognitive ease. Instead of being overwhelmed by the thousands of stocks available, they immediately narrow their field of vision to a much smaller, more manageable universe of potentially high-quality companies. This is not intellectual laziness. It is a highly efficient allocation of a scarce resource, analytical energy. Why waste weeks analyzing the competitive dynamics of a company only to discover at the end that its balance sheet is a ticking time bomb? The no-debt rule allows you to clear the clutter and focus your efforts where they have the highest probability of paying off. It acts as a powerful gatekeeper. A company must prove its financial sobriety before it is even granted an audience. This disciplined, sequential process protects the investor from one of the most common behavioral errors: falling in love with a good story. Many investors hear a compelling narrative about a new technology or a visionary CEO, and become emotionally invested. They then engage in motivated reasoning, where they subconsciously look for data that confirms their initial belief and ignore data that contradicts it, like a dangerous balance sheet. The debt filter prevents this. It forces the investor to confront the cold, hard financial reality of the business before the emotional story has a chance to take hold. It is a logical, dispassionate screen that subordinates story to solvency, and in doing so provides a powerful defense against the psychological biases that lead so many investors astray. This brings us to the final, practical blueprint, the balance sheet first analysis protocol. This is a step-by-step process that anyone, regardless of their financial background, can use to apply this powerful Buffett filter to their own stock market investing. Step 1. Obtain the company's latest annual report, known as the 10K. This can be found for free on the company's investor relations website or on the SEC's EDGAR database. Ignore the glossy photos and the CEO's letter for now. Go directly to the financial statements and find the page titled Consolidated Balance Sheets. This is your starting point. Step 2. Locate the liabilities section and find the line items for debt. They will typically be listed as short-term debt or current portion of long-term debt and long-term debt. Add these numbers together to get the company's total debt. Also find the line item for total shareholders' equity. Step 3. Calculate the first key ratio, debt to equity. Simply divide the total debt by the total shareholders' equity. For a healthy non-financial company, a conservative investor should look for this ratio to be below 0.5. A truly wonderful business, a Buffett-style business, will often have a ratio close to 0. If the ratio is above 1.0, it means the company is financed more by its creditors than by its owners, a significant red flag. Step 4. Now connect the balance sheet to the company's earning power. Flip to the income statement and find the net income for the full year. Or, even better, go to the cash flow statement and find cash flow from operations and subtract capital expenditures to get a rough measure of free cash flow. Compare the total debt to these numbers. A simple and powerful test is the debt payoff time. How many years would it take for the company to pay off its entire debt load using its annual earnings or free cash flow? If a company has $1 billion in debt and generates $500 million in free cash flow, its debt payoff time is 2 years. This is very healthy. If it has $10 billion in debt and only $500 million in free cash flow, its payoff time is 20 years. This is a much more precarious situation. Look for companies that can pay off their debt in under 5 years, ideally under 3. Step 5. Analyze the trend. Don't just look at a single year's snapshot. Look at the balance sheets from the last 5 years. Is the debt level consistently rising? This is a warning sign that the business may be struggling to fund itself organically. Is the debt level consistently falling? This is a positive sign of a management team committed to financial discipline and a business that is generating enough cash to strengthen its financial position. By following this simple 5-step protocol, you are emulating the initial screening process of the world's greatest investor. You are forcing yourself to prioritize financial health over exciting stories. You are building a foundational habit that will automatically steer you toward more durable, resilient, and higher quality businesses, providing a powerful defense against permanent capital loss. The path of the 99% stands in stark opposition to this disciplined, balance sheet first approach. It is the path of story stock investing. The average investor is not drawn to the boring predictability of a debt-free company. They are captivated by narratives of disruption, of revolutionary technology, of a visionary CEO who is going to change the world. They fall in love with the story, and this emotional attachment completely blinds them to the financial fragility of the underlying enterprise. Think back to the dot-com bubble of the late 1990s. Investors were mesmerized by the story of the new economy. They poured money into companies with exciting ideas but no profits, no positive cash flow, and mountains of debt or constantly dilutive stock issuance. Companies like Pets.com or Webvan had compelling stories about changing the way people shop, but their balance sheets were horrific. They were burning through cash at an alarming rate and were completely dependent on the kindness of the capital markets to fund their operations. When the market sentiment turned and the funding dried up, these story stocks collapsed overnight, wiping out trillions of dollars of investor capital. The same pattern repeats in every market cycle. More recently, we've seen it with certain concept stocks in industries like electric vehicles, cannabis, or biotechnology. These companies often have a powerful story about a massive future market, but they are years away from profitability. To fund their ambitious plans, they take on significant debt or repeatedly sell new shares to the public. The story stock investor gets so focused on the potential size of the prize that they ignore the very real possibility that the company will run out of money before it ever reaches the promised land. They are buying a lottery ticket, not investing in a business. The balance sheet is the ultimate antidote to the seductive poison of the story stock. The balance sheet doesn't tell stories. It states facts. It is the unemotional, objective record of a company's financial condition. The 99% of investors ignore it because it's the boring part. It's the vegetables you're supposed to eat before you can have dessert. They want to skip right to the exciting story of dessert. The intelligent investor knows that the vegetables are what provide the long-term nourishment. By committing to the balance sheet first protocol, you are making a conscious choice to reject the speculative, narrative-driven approach of the crowd and to adopt the disciplined, fact-based approach of the professional. The ultimate direct financial connection of this entire fifth pillar is the construction of a truly defensive investment portfolio. By using a low-debt filter as your primary screen, you are not just avoiding risky companies, you are systematically tilting your portfolio toward businesses with a collection of desirable traits that lead to superior long-term performance. Businesses with little to no debt tend to be the ones with durable competitive advantages. Why? Because the very presence of a strong economic moat is what allows them to be so profitable that they don't need to borrow. So the debt filter indirectly serves as a moat filter. These companies also tend to have strong pricing power, high returns on invested capital, and shareholder-friendly management teams. They are, by their nature, the highest quality businesses in the market. A portfolio populated with these types of companies will have very specific and desirable characteristics. First, it will likely exhibit lower volatility than the overall market. These sturdy, cash-generating businesses are less susceptible to economic shocks and market panics. This means a smoother ride for the investor, which makes it psychologically easier to stay invested during the tough times. Second, and somewhat paradoxically, this defensive strategy often leads to superior long-term returns. This is because the power of compounding is driven more by the avoidance of large losses than by the capture of spectacular gains. A portfolio that avoids the bankruptcies and the 50% plus drawdowns that plague highly leveraged, lower-quality companies will often outperform over a full market cycle. The math of avoiding losses is relentless. By ruthlessly filtering out the financially weak, you dramatically increase your odds of long-term success. This is the ultimate path to achieving genuine financial freedom. It is not about finding the next hot stock or timing the market. It is about implementing a disciplined, repeatable process based on timeless principles of financial health and business quality. By making the Fortress balance sheet your non-negotiable starting point, you are doing more than just analyzing companies. You are building a financial future on a foundation of stone, immune to the inevitable storms that will wreck those who chose to build on the sand of leverage and speculation. You have just spent this time acquiring a powerful and profoundly effective mental tool. Think of it as a form of X-ray vision. While 99% of investors are looking at the surface of a company, its brand, its stock chart, its exciting story, you now have the ability to see through all of that, directly into its financial skeleton. You can spot the hairline fractures of fragility, the hidden weaknesses of leverage that are completely invisible to the untrained eye. This debt X-ray is more than just an analytical technique. It is a lifelong filter for avoiding catastrophic error, the single greatest key to wealth preservation in the volatile world of investing. But what you have just mastered, as powerful as it is only the foundation. Warren Buffett's system of identifying wonderful businesses is like building a mighty fortress. You have just perfected the blueprint for the unbreachable foundation, the principle of the fortress balance sheet, but a foundation alone is not a fortress. On top of this foundation, you must build the walls, the towers, and the keep. These other structures are built from different, but interconnected, mental models. How does he evaluate the character and skill of a management team? How does he calculate, with a margin of safety, what a business is actually worth? How does he understand the competitive dynamics of an entire industry? These are the questions that build the rest of the structure. The foundation you've just laid ensures survival. These next principles are what allow for spectacular success. That video appearing on your screen right now is not a random suggestion from an algorithm. It is the next piece of the map. It is the blueprint for the walls that must be built upon the foundation you now possess. It is the crucial link that connects the principle of don't lose to the strategy of win big. Most people will feel satisfied now. They've learned one powerful trick, and for them, that's enough. But you are not most people. The fact that you have watched this far proves you are engaged in a serious pursuit of financial literacy. You are not collecting tricks. You are building a complete mental arsenal. The choice you have now is not whether to watch another video. The choice is whether you want to leave your fortress half-built, with a solid foundation but exposed to the elements, or whether you will continue the work of a master builder. The choice is whether to remain an amateur with one good idea, or to continue your ascent toward becoming a true intelligent investor. Complete your arsenal. Click the video.